Switzerland, remember, is the capital of the banking world. But this is a title that it may lose soon.
Shares in Credit Suisse fell by more than 60% this morning.
The stock was worth less than 2 Swiss francs, and this fall is bigger than the Silicon Valley Bank because Credit Suisse is a much bigger bank.
UBS has agreed to take over the 167-year-old Swiss bank giant Credit Suisse in a deal worth $3 billion.
UBS intends to downsize Credit Suisse's investment banking business and align it with our conservative risk culture.
The bank's credit default swap price has jumped to its highest level.
Hi, everybody. Credit Suisse was one of the biggest banks in the world. And as we all saw, days after the collapse of 2 U.S. banks, now Credit Suisse got into trouble. And if you look at the magnitude of this disaster, it will blow your mind. This is what the share price of Credit Suisse looks like. Ever since their peak 16 years ago in 2007, Credit Suisse has lost 99% of its share price. And mind you, Credit Suisse is no normal bank. It was the second largest Swiss bank, and at one point contained about 1.3 trillion Swiss franc in deposits. And despite it being taken over by UBS, even though there is a lot of panic in the market because we are looking at a banking crisis in not one but 2 continents. So this begs the question, what led to the fall of Credit Suisse? Where did the economics go wrong, and how will this affect the economy? To understand this, we need to track the total assets since 2005, and in that year, they had 1.3 trillion Swiss franc in deposits. And from that year onwards, it steadily declined to 818 billion in 2020. And then, there was a steep drop to just 531 billion in 2022. This shows that Credit Suisse's demise began way before the US banks collapsed, before the Russia-Ukraine war, and even before the COVID pandemic. So we need to find out what happened to Credit Suisse that made it go from a trillion-dollar company to getting close to bankruptcy. To understand this, you need to know that there are 4 streams of revenue. Revenue from their wealth management division, revenue from the Swiss bank itself, revenue from its investment banking division, and finally from its asset management division. But actually, these 4 branches were doing very well. However, if you look at this graph, you can see Credit Suisse allocated billions of dollars only for litigation expenses every single year, such as case filings, court fees, arbitration fees, and attorneys. The question is, why did they spend so much money on just litigation? Well, this is where the dark side of Credit Suisse comes in.
The bank has faced a host of scandals. In Bulgaria, it allowed drug dealers to launder money.
Credit Suisse has agreed to plead guilty.
Credit Suisse became the first bank in more than a decade to face criminal charges over helping Americans evade tax.
Credit Suisse will pay more than $2.5 billion in fines.
This is the largest bank to plead guilty in 20 years.
Then there was a spying scandal. The bank snooped on its top executive. Last year, there was a massive data leak. And all these scandals led to losses.
Furthermore, in 2014, Credit Suisse was fined $2.6 billion and pleaded guilty to helping Americans evade taxes for decades. Then, in 2017, it was the biggest settlement, having to pay more than $5 billion to settle with the U.S. authority over claims that it misled investors in residential mortgage-backed securities that it sold in the run-up to the 2008 financial crisis. Then, in 2019, Credit Suisse was caught in a corporate espionage scandal, where a group of executives had been later found to have ordered private detectives to track 2 outgoing executives. This triggered a regulatory investigation, and its then CEO, Mr. Thiam, stepped down from his position in 2020. So for the past decade, Credit Suisse has constantly found itself in trouble with regulators. But even then, nothing happened because the bank was extremely profitable and could easily pay its fines. And despite its scandals, the millionaires and billionaires of the world, and even the corporates of the world, continued to see Credit Suisse as a reliable bank. So as long as their customers had confidence in them, Credit Suisse could continue making billions of dollars every single year in spite of the litigation. But all of this changed when Credit Suisse got involved into 2 high-profile disasters, which are Greensill Capital and Archegos.
Greensill dominating headlines.
The collapse of supply chain financing company Greensill Capital embroiled the bank.
I mean, it's a spectacular fall from grace for Greensill.
I know that one hedge fund had decided to short Credit Suisse because of these frozen Greensill funds.
Credit Suisse had provided financial backing to Greensill as it began to struggle.
Archegos-related losses have been really in the spotlight.
The collapse of Archegos brought Credit Suisse $5 billion of losses.
The Archegos collapse cost its lenders a collective $10 billion.
Credit Suisse, the most hardest hit of the banks tied to the Archegos capital collapse.
To put that straight, Credit Suisse saw $5.5 billion due to its risky exposure to the U.S. hedge fund, Archegos Capital Management, which collapsed in 2021. But even worse was Greensill. Credit Suisse was a major backer of Greensill Capital, and this company sold bonds to their high-net-worth wealth management clients, saying that they were almost risk-free bonds. But in 2021, Greensill collapsed, and Credit Suisse was forced to suspend $10 billion of investor funds. And after this incident, the rich depositors at Credit Suisse got frustrated. So, throughout 2022, the wealthy clients started pulling their money out of Credit Suisse. And given that asset management was their highest income-generating business, when that decreased by 27%, it was a huge setback for Credit Suisse. And the icing on the cake were the rumors that the bank was shutting down. So, all of this put together caused the outlaw of almost 100 billion Swiss francs in the last quarter of 2022 itself. And this is quite understandable, right? If you're a millionaire with $10 million deposited and managed by Credit Suisse, even if you think there is 1% chance of the bank completely failing, you would immediately pull all your money out and put it in a competitor bank. Well, this is exactly what the depositors of Credit Suisse did. And this is when the bank started derailing. In every single quarter of 2022, the reported net income was negative after adjusting for litigation charges. And Credit Suisse reported a pre-tax loss of 3.3 billion Swiss francs, which is about 5 times the jump from their losses of 600 million in 2021. Just when everybody thought things couldn't get any worse, the final nail in the coffin came in with the U.S. bank's failure, including the Silicon Valley Bank. And when this happened, the panic in the market snowballed and sent jitters down the spine of all Credit Suisse depositors and investors. This is the reason why, if you look at the numbers, it is absolutely terrible. Their stock price had fallen to just 1.8 Swiss francs, which was 74% less than the previous year, and more significantly, their credit default swaps skyrocketed in value again. If you don't know what a credit default swap is, let us know and we will make a video on it soon. Now this graph mentions to investors the cost of credit default swap or CDS. Now if this cost increases, it means that the cost of insurance is going up, which means the risk of the asset is increasing. So, in short, if the price of CDS goes up, it means that the risk is increasing. Now, if you look at this chart, you will see the price of a 1-year CDS for Credit Suisse. So, back in June of last year, we could buy a Credit Suisse 1-year CDS for just 67 basis point or 0.67% of the total debt we owned. So, this is a very small amount, implying that there is little to no risk in owning Credit Suisse debt. Back in the end of 2022, it stood more closer to 500 basis points. But now in 2023, this number has shot up to 3,460 basis points. This means that the cost of insurance is 34.6% of the debt. So if you buy a bond of $100,000 from the bank, while you were only paying $670 to insure it, now, for the same bond, you will have to pay $34,600. And the fun fact is that anything at 1,000 basis points or above implies a high likelihood of default. So the moral of this number story is that if the bank is not rescued, it will go bankrupt. Now, had it been some other bank, it would have been no big deal at all. But for Switzerland, Credit Suisse, if a critical part of the Swiss economy, so if Credit Suisse collapses, it will damage the Swiss economy, and more importantly, it will question Switzerland's credibility as the banking central of the world. This is also the reason why the Swiss National Bank immediately gave a $50 billion credit line to provide liquidity to Credit Suisse. Essentially, they guaranteed that there will be no default at all. Now, the Swiss knew very well that this is not a long-term thing at all, and it's not enough to restore the faith of the depositors and the investors. This is the reason why they arranged the sale of Credit Suisse to UBS Group, which is the largest bank in Switzerland. Now, even UBS operates in the same space as Credit Suisse, whereby they have the business of wealth management and investment banking, with offices all across the world. And the only difference between UBS and Credit Suisse is that UBS knows how to not waste its money into scandals and lawsuits. Moreover, UBS took an insane advantage of the situation, that while Credit Suisse was valued at 8 billion Swiss francs, UBS offered them barely 3 billion Swiss francs to buy them out, which means they only paid 0.76 Swiss franc per share to buy Credit Suisse. That is a 99% decline from Credit Suisse's peak valuation in 2007. So the question is, what is the future of Credit Suisse, and what is going to happen to all the money in the bank? Well, firstly, the Swiss National Bank is offering 100 billion franc liquidity assistance to UBS. Secondly, if they encounter potential losses from assets, UBS would bear the first 5 billion Swiss francs, and the federal government will bear the next 9 billion francs. And lastly, about 16 billion francs of Credit Suisse bonds known as AT1 bonds will become absolutely worthless. If you do not know what AT1 bonds are, we will also be making a video on that soon. But in short, AT1 bonds are a type of hybrid debt instrument issued by banks. They are a special kind of loan that banks can get from people or other organizations. These bonds help banks to have enough money to handle difficult situations. If a bank is in trouble, these bonds can be turned into shares of the bank or canceled altogether. This helps protect the bank and keeps the financial system stable. They have an extremely high interest rates, which makes them appealing to the client. However, the catch is that they come up with some very sharp terms and conditions. Number 1, the high interest rate paid depends on the bank's financial conditions. So if the bank is in losses, it can even choose to forgo the interest that year. Number 2, the investors cannot pull out this bond at their will. Only the banks have right to do so at their call date or maturity date. So investors can only sell and trade this bond in the secondary market. And most importantly, if it so happens that the bank fails, AT1 bondholders will not be given priority at all. In fact, all the AT1 bond amount can be written off, which means the bondholders have a chance of never getting their money back at all. And this is exactly what happened in Credit Suisse with $16 billion. When the bank fell to UBS, 15.8 billion Swiss francs of Credit Suisse's AT1 instruments were written off by regulators completely. So $16 billion worth of investor wealth was completely wiped off. Now, these were the stories, concepts, and economics behind the Credit Suisse crisis. We hope you enjoyed this video and maybe learned something along the way. If you would like to see more videos like this, please let us know in the comments below. Thanks for watching, and we'll see you in the next episode.